All right, let's talk about something that's absolutely enormous, incredibly powerful, and for most of us, completely hidden from view. We're going to pull back the curtain on a part of our financial system that operates in the shadows.
So let me ask you this. What if I told you there's a financial system out there controlling trillions upon trillions of dollars, but with no safety net, none of the rules, none of the protections we just assume are there? What would that even look like?
Well, the thing is, this isn't some crazy hypothetical. It is very real. It's called shadow banking. And today, we're going to step right into that world to figure out what it is, how it works, and, why it matters so much.
Okay, first things first. What is shadow banking really? To get a grip on its impact, we need to start with a clear definition. Think about it like this. You have this whole network of financial companies, and they're doing all the things you'd expect a bank to do. They lend money, they borrow money, they invest. But, and this is the huge but, they do it all without the usual rules. No government supervision, no FDIC insurance if things go sideways, basically no safety net. And don't think for a second this is some tiny, obscure corner of the market. We are talking about some seriously big players here. You've heard of them. Hedge funds, money market funds, private equity firms. Even parts of big insurance companies and mortgage lenders are in on this. It's this massive, sprawling ecosystem that's all around us. So let's put it side by side to make it really clear. The bank you probably use, right? It takes public deposits, your money is insured by the FDIC, and the Federal Reserve is always keeping an eye on them. Shadow banks? Nope. They don't take public deposits, they are not insured, and they operate outside that direct oversight. It's like they're playing a totally different game, with way fewer rules. So you have to wonder, how did this whole parallel universe even get started? Well, it didn't just pop up overnight. It actually grew out of a really specific period of change in the financial world. Let's rewind to the 1980s. This was a time of major financial deregulation. Wall Street started looking for new ways to make bigger profits to get around the old restrictions. And that search sparked this huge wave of innovation. All of a sudden, you have these new financial products, like mortgage-backed securities, and this thing called the repo market, which is just a fancy way of saying a giant market for overnight loans. These became the Lego bricks for building a brand new system, and man, did it grow fast. All right, so we know who the players are and how they got here, but what's the actual game plan? How do they make all this money? Well, the formula is actually pretty simple, but as you're about to see, it's also incredibly dangerous. So here's how it works, step by step. First, they get capital from investors. That's step one. Step two, they take that money and use it as collateral to borrow a ton more money, usually on a really short-term basis, like overnight. Then, step three, they take all of that cash, the investors' money and the borrowed money, and sink it into long-term investments, things like mortgages or corporate loans. It's the classic borrow short, lend long strategy, just supercharged. Now here's the catch, and it's a big one. This whole thing works like a dream and makes a ton of money, as long as the music is playing and the markets are stable. But what happens if things get a little shaky? What happens when those lenders giving you money every single night suddenly get scared and say, you know what, I want my money back now? That's when the whole thing becomes a house of cards. And we don't even have to guess what that looks like, because we all saw it happen. We're talking, of course, about the 2008 financial crisis. This was the moment that the shadows didn't just get exposed, they collapsed. Domino number one, the U.S. housing market. The foundation of this whole structure falls apart. Domino number two, remember all those mortgage-backed securities they invested in? Well, they were built on those exact risky loans. All of a sudden, those assets are worth way less. The collateral they were using to get those overnight loans? Pretty much worthless. Domino number three, panic. Pure panic. The people and institutions providing all that short-term cash just stop. They pull their money out. The entire lending system that these shadow banks relied on to live day to day just freezes solid. It's gone. And then the big one, Lehman Brothers. A giant in this world can't get the short-term funding it needs to survive. It declares bankruptcy. And that's the moment the whole dam just breaks, sending a tidal wave of fear through the entire global economy. What 2008 really hammered home was that this shadow system wasn't some separate thing. It was completely tangled up with the traditional banking world. They were interconnected. So when the shadow system failed, it threatened to pull everything, and I mean everything, down with it.
So after a complete catastrophe like that, you'd think, okay, they must have shut this whole thing down, right? Or at least put some serious rules in place. But, and this is the really wild part, that's not what happened. In fact, it's now bigger than it has ever been. Get ready for this number: $200 trillion. That's the estimated size of this system today. It's mind-boggling. It didn't just survive 2008, it actually thrived in the aftermath. Which brings up a huge question. Why?
Well, this really gets to the heart of the debate. On one side, there's a reason it exists. It provides flexibility and speed. It can increase access to credit and support financial innovation. It's a source of essential liquidity for the markets. But the flip side is pretty scary. It creates all these hidden risks, it lacks transparency, and it's a potential source of massive instability that can just amplify shocks to the system. So you can see the problem for regulators, right? How do you control the crazy risks without killing all the good things it does for the economy? It's this constant tightrope walk between stability and financial freedom.
And this quote just nails it. We always think about the big, famous banks with their names on skyscrapers, but so much of the real power and the real risk isn't there. It's in the shadows.
So that's where we are today. The shadow system is larger than it has ever been. So I'll leave you with this question. Does that mean our global economy is more efficient and innovative? Or are we just sitting on top of an even bigger, more complicated ticking time bomb, just waiting for the next crisis? Something to think about.